All right, you decided to invest. You either came across some money or you made some money, and you finally decided to take on a journey of investing, but you don't know where to start. This video is perfect for you. This video is for the beginners, but if you're intermediate or advanced, stick around. Maybe you'll learn something new. You probably heard of inflation. To understand why we invest, we need to understand the inflation. And inflation basically is increase of prices and drop in purchasing value of your money. So over time, our money loses its value. And in order to combat that, we need to invest. To understand better what inflation is, let's give it an example. Example is you walk into the store in 1960 and you try to buy a gallon of milk. You'll pay about $1. So back then, a gallon of milk was about $1. Now, let's do the same thing today. You walk to the store today and you try to buy a gallon of milk, you pay on average about $4.50 depending on what store you went to. That's a perfect example of inflation. Over time, prices increase and the value of your dollar drops. And inflation generally is about 2.5%, but in 2022, inflation is 9%. So how do we grow our money? Well, if there was a hypothetical super savings account and that account was paying interest of 10%, that would be awesome. You walk into the bank, you open that account, you deposited your money, and all of a sudden you are earning 10% annually. So let's say, for example, you put $100 into that account and you completely forget about those $100. By the end of the 10th year, so you leave it for 10 years, you'll have about $210 in that account adjusted for inflation, which is practically awesome because you just doubled your money without doing anything. In the real world, accounts like this don't exist. The best accounts pay about 2%, which again, inflation is about 2 to 2.5%. So in the best case scenario, you're breaking even, but in most cases, you're losing your money. So what do? We're going to talk about two ways to invest. One is real estate and two is stocks. So let's start with real estate. So real estate, a perfect example of investing your money. Let's say you have 20% on a down payment, you found a perfect house, you purchased it, it's in a great area. There are two ways you're making money from your investment. One, you collect and rent. And hopefully if you did your math right and your numbers are correct, you are actually cash flowing on that property. And if you don't know about cash flow, I've made a video before. I'll link it right here or here, I'm not sure. And you can go and watch that video and to better understand what cash flow is and do the analysis of the property to make sure your property is cash flowing. And then two, which is growth of equity, aka capital gains. So you bought a property, you collect and rent, your property is increasing in value. However, like everything else in life, it comes with risk. Let's say you purchased your property and you didn't do your math, or you bought it in 2007, right before the 2008 financial crisis. So you bought it at the top of the market. In the next 2 years, your property lost about 14%. There's a saying by Warren Buffett, and I might be paraphrasing it, but he says, time in the market beats timing the market. So if you bought it in a wrong time, don't worry about it. Just keep it, as long as it covers its basis and it's paying for itself, keep it, and over time it will grow in value again. But let's say you don't have the funds to buy a house, or you don't have the credit, or it's just buying a house is a process. It's stressful. Let's say you're not there yet. How do you grow your money? Let's say you only have $500, but you want to start growing. This is a perfect segue to go into our next best thing, which is stocks. Investing into stocks has been my passion. I've been doing it for a little bit over 6 years, and it's been quite a journey, a lot of ups and downs. The way I keep my investments, I have 50% in stocks, 40% in real estate, and 10% is spread between other assets like cryptocurrency. Picture a delicious mouth-watering cake. Let's say you get a little slice of that cake. That's pretty much what the stock is. Stock is a piece of ownership in a company that big corporations sell to you in order to raise money. And they usually do that during the IPO, initial public offering. Once the IPO has been released, the stocks start trading on the biggest exchanges in the world. And you and I can go ahead and purchase it. A good example would be a company like Tesla. Let's say Tesla had an amazing year and they're feeling super generous, so they want to pay a dividend to their shareholders. And let's say they want to issue a $1 billion in dividends. So let's say hypothetically you own 1% on Tesla shares. You as a shareholder will receive 1% of dividends. So that's one way of making money from stocks. But just like in real estate, you can also make capital gains. If you bought your share of Tesla in 2015, the cost of that share was about $38. Now, let's say you bought 10 of them in 2015 for $38. If you held it till today and you wanted to sell it, at the time of making this video, the cost of share for Tesla was $866. So you will lock in a capital gain of $8,280, which is pretty good return on your money considering you only invested initially $380. So how do you buy stocks? Back in the day, you would have to call some guy in a brokerage and place your order. Nowadays, it's much simpler, like everything else with the internet age. You can just open an online brokerage account and start buying your shares without interference of a third party. I personally have accounts with Robinhood, Merrill Edge, and TD Ameritrade. You open your account and you're ready to start purchasing shares. What shares should you purchase? I would not recommend buying individual stocks. Going back to a risk factor, purchasing individual stocks requires a certain level of sophistication and advancement in understanding stocks, and you need to know how to read financial statements. You need to be very well versed into that subject to understand what stocks to purchase. And even then, there are analysts that do it for years and they still lose money because they cannot beat indexes. And the whole point of investing into individual stocks is to try to make more money than an index. Index measures the performance of the stock market, and there are ETFs that track indexes like S&P 500 or NASDAQ or Dow Jones. Some of my favorite ETFs are Vanguard Total Market, which is VTI, and then Vanguard 500 companies, which is VOO. These are the ticker symbols. I'm gonna just list them down below. So VTI and VOO, I invest a lot of my money into those. I'm also, being that I've been in the market for almost 7 years now, I am invested in some individual stocks. There is a level of risk that I already talked to you about, but I've taught myself how to read financial statements, and I just overall feel a lot more confident in doing so. I do not advise that to beginners. When and how should you get started? Start as soon as possible. As soon as you feel like you have enough money to start investing, you should start. So here we are on investor.go. As you can see, there's a compound interest calculator. Let's say you are 20 years old. You have $100 to invest. Your monthly contribution is going to be about $100. So every month, and the length, since let's say you're 20 and you want to invest till you're 60, so 40 years. So for the next 40 years, you will be investing a $100 bill into your portfolio for the remainder of 40 years. Estimated interest rate on your investment is about 8%. Generally, S&P 500 makes about 8 to 10%, and there is a variation of 2%. And then we are going to compound it annually. Let's calculate that. As you can see, the results for 40 years. If you were to start at 20 and you invested for 40 years, on average, have $313,000 in your bank account by the time you're 60. Now, let's go back, and instead of 40 years, we'll do 30 years. We will leave the estimated interest rate at the same 8%, and we will leave an interest rate variance range at 2%, and we'll compound on annual basis again. As you can see, the difference is substantial. There's almost $170,000 difference for you just starting 10 years later. So starting early, it's very important. The sooner you start, the more you can accumulate over years, and depending on how much you contribute. And this is bare minimum, right? Let's say you change that to $1,000 and you do it for 40 years, $3 million right there. Start as early as you can. Investing is a journey of a lifetime. It's not a get rich quick scheme. Investing takes discipline, it takes calculation, but the sooner you start, the better off you are. Hopefully this video encourages you to start investing. If you have any questions, feel free to leave comments below. If this video is helpful, like this video, consider subscribing, and as always, I'll see you in the next one.